and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our guest today. T.S. Harihar joins us today. We have Vivek Mavani as well as Senthil Manikandan who joins us on the show. Thank you to all for joining me on the show. The stocks that we'll discuss on Hot Money today, we'll discuss the paper stocks because paper as a sector is doing extremely well. We're asking our guest one Nifty stock that could probably correct. We're asking them a recommendation of a small cap stock, and HUL is trading near record highs. Will the rally continue, or is now valuation getting too steep for HUL? We'll start with the first one, and that is the paper stock. So, Hari, I'll start with you. Paper stocks have done extremely well as of now. Any view on the paper stocks? Do you like any of the paper stocks as of now?
Well, not exactly. We have actually been a little skeptical of paper stocks for two reasons. One is considering the environmental implications of paper. Number two, considering that we are actually moving towards less use of paper and more use of non-paper kind of sources. So I would believe that broadly as a sector, paper probably is not a very attractive sector to be in. If I was to look at specific stocks, then probably instead of going for a pure paper company, I would look at something in ITC, which is a fairly large paper franchise. The ITC Bhadrajan is a very large paper franchise. So probably look at ITC, which is essentially an FMCG plus cigarette company with a franchise of paper. So as a proxy for paper, we would probably look at ITC, but pure paper companies would be a kind of an avoid for us. Okay, that's the view that's coming in on Hari. Pure paper companies would be an avoid. ITC as a proxy bet to the paper stocks. Vivek, any of the paper stocks that you like?
Yeah, I do like JK Paper. I mean, to me, that seems best placed to ride the paper cycle. And just to give you a little background, paper sector over 15 years has had a lot of stress driven by overcapacity. Number one, a lot of unviable capacity which was also there, which never allowed paper prices, the end paper prices to really go up. There were imports from China, and as Hari mentioned about environmental aspect also. What we have from 2016 onwards, and this scenario actually has been shaping up over the last 2 years actually, is that a lot of the unviable capacity is shut for the last few years. Demand has continued to grow, and China imports have reduced significantly because of anti-dumping duties. The better pair, the larger ones have got their cost structures, they have gotten more efficient, and hence their cost structure is lower on a per tonnage basis, and now paper cycle in terms of end prices globally is on a rise because a lot of capacity even in China is shut, a lot of capacity elsewhere in the world is also shut, while globally demand has continued to grow. So, and this cycle is likely to probably go on for a while, maybe not 5 years, but at least another 1 year or so. So it's a trading play. JK Paper to me seems the best place to ride that as a trading bet. Besides the opening remarks, I'll come back on details on JK Paper, but I'm positive on the sector.
Okay, positive on the sector. Senthil, which paper company do you like?
Like Vivek mentioned, the major trigger for the entire industry has been the China's anti-dumping duty on the waste paper. What has done is with the anti-dumping duty on the waste paper with China, there has been a tremendous supply of waste paper coming to the developing markets like India from the developed markets. So this has resulted in paper companies' raw material prices going down substantially, while other than their realization has gone up substantially. So these two major factors played a tremendous role in the last 1 year for all the paper companies. So within the lot, we like Ruchira Papers majorly because their raw material is based on agro waste compared to other paper manufacturers who are based on wood pulp, like RES mentioned, like it's environmentally damaging impact. But here the company is based on agro waste, so that's a positive for them. And second thing is their product, they are into two products. One is the printing and writing, second one is the craft paper. So within the paper industry, what you are seeing is growth for the craft paper is in the range of 8 to 9%, while for the other products are in the range of 3 to 4%. So majorly the craft paper growth is driven by the packaging industry's demand. Second factor could be their upgradation and expansion what they have done in the craft paper segment. So the company has gone for a upgradation in the craft paper. With that, they are moving into the high quality craft paper segment. So this is like a margin accretive going forward. So with this in consideration, I think we like Ruchira Papers.
Okay, Ruchira Paper is something that you like. Any kind of potential upside that you all see in Ruchira Paper?
So currently after the correction, I think the stock is trading at around 6 to 7 times in line with the industry. But considering the 2-3 major points which I highlighted, I think the earnings CAGR over the next 1-2 years could be tremendously higher versus the industry. So even though we expect the price to earnings multiples of the entire industry to stay in single digit, considering the growth prospects to be in the limited side, I think we are expecting around 20-30% kind of return from this.
Okay, Vivek, specifically to JK Paper, what are the triggers?
Two. Like in any commodity, I mean, when there's a price upcycle, I mean, the best company in the sense with a multiplier profit effect is the one which has higher volume growth. So in the sense, they need to have surplus capacity to ramp up volume growth at higher prices. And of course, a cost structure being low, and which is what I touched upon earlier. JK last year acquired Sirpur Paper, which was a unit which was non-functional, which is now likely to start contributing to earnings from this year onwards. It's probably the second or third largest in terms of capacity, in excess of 5 lakh tons. So they have the capacity headroom, a cost structure which is significantly lower than the average. So it will at least be able to ride out even certain challenging periods when where obviously commodity prices don't go up one way. But JK Paper will continue to improve the profitability. They are already at about 23-24% EBITDA margins. The deleveraging is also happening over the last couple of years. And in terms of valuations, it's about maybe 6 times current year earnings, 6 times EV by EBITDA. I mean, most commodity companies, we would look at EV by EBITDA. And with deleveraging, so a lot of the debt will actually convert to market cap in terms of stock price gains. So from about 180 levels, we've been, I mean, we're still positive. Probably it can go up to about 250 in about a year's time.
Okay, so that's the view that's coming in on the paper industry. Hari, as a proxy play, likes ITC in the paper stock. Now, no exactly paper company that he specifically likes. JK Paper and Ruchira Paper are the other two stocks that have been discussed today. The next one is that we're asking that since the markets and the Nifty, especially the Nifty, is at 11,500, most of the stocks are trading at record highs. Is there any Nifty stock which they believe probably could correct from these levels? So that's the question that we're asking. Vivek, I'll start with you. Which Nifty stock do you believe that has run off? It has lost out steam now and probably could correct.
Okay, so I'll address it in two ways. I mean, last few months or 2018 to be in particular, we have seen mighty strength of the dollar. I mean, dollar index has been very strong, leading to weakness in currencies across the world, especially in emerging markets. Even rupee has seen about 10% depreciation in the last few months. I've been looking at last 20 years correlation between Indian rupee and dollar versus Nifty. Nifty as a proxy for Indian equity markets, and the correlation is very strong. I mean, whenever rupee has weakened in the short term sharply, I mean, if there have been sharp movements, Nifty has corrected also sharply. Of course, Nifty has bounced. I mean, when there's been stability in the currency markets, even equity markets have sort of recovered. But along with the dollar strength, what we have also seen is all the commodities, whether it is crude, metal commodities, base metals, including precious metals, gold and silver, all of them have also corrected significantly in the last few weeks. So, and if the dollar strength continues for rest of the year, probably commodities don't really have a very positive outlook on the international prices. So there I find Vedanta to be most vulnerable. Again, I'm assuming I'm assuming that the dollar strength will continue. And with the dollar strength, actually the whole Indian market is vulnerable, including all emerging markets are vulnerable. But commodities are probably more vulnerable than non-commodity. So it's not that FMCG is not vulnerable, but FMCG is less vulnerable compared to commodities, and that's where I find Vedanta to be having some weakness, having exposure to aluminum, copper, zinc, silver and crude oil. I mean, you have 5 global commodities all packed into Vedanta, and weakness in global commodities could be quite difficult for Vedanta.
Okay, so that's the view. Vedanta slightly weak. Hari, which Nifty stock do you believe is overvalued now, or probably could correct in the near term?
I think ICICI Bank has a problem. I think it's rallied from about 260 to over 320 in the last few days. and there is not much has changed. I agree that probably at the top there has been a change, but if you look at the NPAs, I think it's still about 8%. So I don't think that's a very comforting scenario. Number two, there are a lot of loans which are yet to be classified. I think we had a big problem last time about the nature of classification. I think the latest round of whistleblower revelations are also out, where they have raised questions about the way large groups are actually given loans to the bank. So I think there are some serious issues of governance, of potential NPAs as far as the bank is concerned. So anybody, I would believe, who is long should probably use this bounce in ICICI Bank to get out of the stock. I think that is one stock that looks very vulnerable at these levels.
Okay, and what about valuation-wise, ICICI? That's still what we've seen recently is that the high-value stocks aren't getting money, but some of the low-value corporate-facing banks like Axis and ICICI are getting. So is that a risk that someone should take?
I don't think it's so much of a corporate facing banks getting. I think it's more of what I call an ETF rebalancing that's been happening, because an ETF by default who is exposed to an MSCI index in India, they will have to have a certain proportion of ICICI Bank, like it or not. So I think what we have seen in the recent past is probably a little more of ETF rebalancing. Now, I don't think there is any corporate preference or anything that is coming. At least I don't sense that when I talk to these analysts and fund managers. Yes, I think ICICI Bank at 250 probably looked a little underpriced, and there was a case for rebalancing. So I think that is what has happened. I wouldn't read too much into that, frankly.
Okay, Senthil, which stock?
I think my first pick would be the HUL, but since we are discussing lately, my second would be the TCS. Majorly because the dollar appreciation coupled with their better performance in the Q1 quarter has seen the stock appreciating nearly 40% to 40% in the last 6 months period. I think most of the positives have already been factored in this stock.
Okay.
And also the recent buyback at 2,100 rupees also is providing support to the stock. But with the buyback recorded already passing out, I think with stock trading at around nearly 25 times 1 year forward earnings, for a growth potential for the business stands at around 8 to 9%. So considering the disparity between the growth potential and the valuations, I think TCS would be one stock.
Okay, so basically valuation is something you feel is expensive.
Yes.
But the IT sector with the dollar, how it is panning out, and the earnings, it's always managed to outperform. Is that not a risk that you would take?
So that's what I'm saying. Like in the last maybe say last 1 or 2 months, the dollar has appreciated quite a bit. This is like a tailwind for them, but considering the business potential for the segment going forward, with a lot of disruptions coming in, and if you look at 1 year back, everybody was speaking about the disruptions on all of kind for the major IT players. So in the IT pack, I accept that the dollar is going to be a tailwind. I could prefer the small IT companies like Persistent Systems. So those having a tailwind of dollar, plus also the business is also looking on the upside. So I get to prefer them versus the large IT players.
Okay, and Vivek, just wanted to, so out of the 50 stocks, you believe that the others probably, you've just said Vedanta looks weak. You believe the others too do have the potential, they'll keep on rising?
No, not really. As I said, I am putting the perspective of the strength of the US dollar and weakness of INR, which itself puts the entire Indian market vulnerable. I mean, so it's not that an HUL or a TCS or a Sun Pharma or ACC will not correct. Of course, they will also correct. It's just that in commodities, we are seeing a double whammy, where even international commodity prices are also correcting, and you have the, so that is a perspective. Otherwise, lot other stocks within the Nifty, purely on valuations and disappointment in terms of growth rates, are vulnerable. I would the second hurry on ICICI Bank. Even I'm concerned about the sharp rally that we have seen in ICICI Bank from 260 levels to 330 in the last about 1 or 2 months, without really seeing underlying improvement that all of us want to see. It's just that probably technically the stock was just too oversold, and hence there's a bounce back. But fundamentally, I would still want to see improvement, which I think is still not there.
Okay, so that's the view that's coming in on the Nifty stocks. So counters like ICICI Bank, there is Vedanta as well as TCS. Probably if the market takes a U-turn at this point of time, these are the counters that you need to watch out. Probably that could go down even further from these levels. The next one is that, we've seen that, off late the broader market, initially we just saw the Nifty counters move up. Off late the broader markets have moved up. A lot of these mid caps and small cap stocks have been performing. So we're asking our guest which is the small cap stock that they believe could be a good add to the portfolio. as far as the current levels are concerned. So Senthil, among the small caps that we have, which is the counter that you like?
So we like Parag Milk Foods.
Okay.
We like the entire dairy industry itself, and within them Parag, 2/3 of the revenue comes from their value-added segment.
Okay.
And in the recent con call they mentioned, like with FY18, their current retail footprint stands around 2.6 lakh. They are expanding it by another 1 lakh. So, and they recently acquired Danone's facility in the north. So they will be expanding towards north. So I think the revenue growth is going to come from their expanded product portfolio plus the expanding distribution range also.
Okay.
And the recent disruption in the milk prices in Maharashtra is also like a benefit to them. Like Maharashtra government is providing a subsidy of 5 rupees, and this subsidy of 5 rupees is only for those value-added products. So with Parag majorly into the value-added products, they will be the most beneficial among the dairy majors itself. And the valuation is also looks reasonable at around 24 times trailing 12 months earnings. And management's focus on further increasing their value-added segment, especially in the health and nutrition category. It looks good from the long-term potential.
Now, how does Parag play out against its peers in terms of valuation and the financials?
So if you look at the Hudson, which is also like a kind of value-added play, Hudson, if you look at the market cap is around 11,000 crores, and last year's PAT was around 100 crores. So it's trading at around 100 times. Considering this abnormal valuation for Hudson versus the Parag, which is trading at around 25 times, I think Parag would be a better play in the dairy segment.
Okay, so Parag Milk Food is something that Senthil likes at this point of time, trading flat in today's trade. Vivek, among the small cap stocks, which one do you like?
Well, I'll pick Indian Terrain Fashions, which is a well-known brand and a leading brand in menswear, and in the last 2 years they've also forayed into boys wear, kids wear, but boys. So basically it's a theme. The stock has corrected more than 40%, almost 40% from to almost 230 levels, 240 levels to 130. But basically it rides on the trend of branded to unbranded, unorganized to organized, shift of sales from mom and pop stores to exclusive outlets, malls, the organized retail as we call it, etc. And within the branded space, premiumization with people upgrading from lower priced brands to higher priced aspirational brands. And Indian Terrain is well placed on that. It as of June end, it had 155 exclusive outlets and presence in 1800 department stores, multi-brand outlets, which is quite deep, and that distribution reach is expanding every quarter. They've been sustainably growing in mid-teens for a long time, for last many years, since the time it was the data is available from the time it was demerged from what used to be Celebrity Fashions, which is now a sister company owned by the same promoters. On valuation, it's trading at just about 8-9 times EV by EBITDA and about 16-17 times earnings for a branded company. One of the reasons is a return on capital, return on equity, and you would recollect I'm pretty finicky about return on capital and return on equity is still low at about 12%. But as their scale improves, I mean they're already at 400 crores, they'll probably be about 450, 460 crores in the current year. So as their scale improves, so will the margins expand, and so will the return on capital and return on equity expand, will also grow. So I find this to be a good long-term bet to be accumulating on declines and hold as a portfolio for a long time.
Vivek, who would be the direct peers if you want to do a comparison in this with Indian Terrain, and what would in terms of that valuation in the peer segment, how does this company stand?
Well, if we are looking at peer group, then what I'm looking at is product competition. Well, product competition, we have Zodiac, we have the likes of Van Heusen and Louis Philippe and Peter England and those kind of brands. I mean, one just needs to take a round in a mall and you have a whole array of brands in the men's ready-made garment space, in the men's and boys wear. So even Aditya Birla Fashion and Retail, what used to be Pantaloon earlier. So all of those brands on a product-wise, they compete. If we were to look at the valuation, I mean, in that sense, peer group in terms of how does the performance compare? Well, then this probably is one of the cheapest branded plays, because none of the others, whether it's Aditya Birla Fashion or Zodiac Clothing, have profitability that is comparable to Indian terrain fashions. Indian terrain fashions, by the way, makes about 12-13% EBITDA margins. Comparable also could be a Keval Kiran, which makes killer jeans, and they have also got array of brands in shirts and t-shirts and casual wear, where the EBITDA margins are much higher, but so is the valuation also higher. I mean, Keval Kiran is also a stock that I've liked in the past, but valuations, it's Indian terrain which are more supportive.
Okay, so Indian terrain is something that Vivek likes at this point of time, and Hari, which is the small cap stock that you like?
Well, see, first and foremost, a caveat. We are a little cautious on small caps, especially when the Nifty is, I think it's about 25 times, historical earnings that it's quoting at right now. And secondly, small caps are hard to define, but let's assume $1 billion is what we are looking at as a cutoff. Interesting, one of my favorite small cap stocks has been graphite, but unfortunately, a $400 million stock has now become about 3.2 billion. So I think that's a risk we run. But having said that, if I was to look at a small to mid cap stock, probably graphite would still be my top pick. And I think even at current prices, I would believe that if you look at the big expansion in the steel capacities, to about 3 times by 2030, and the concomitant demand that it creates for electrodes, I would believe that graphite probably looks one stock, where the future over the next 5 or 6 years appears to be very, very secure. So I would probably stick to graphite at this point of time.
Okay, a couple of things with needle coke prices going up, and the management has said that it's not factored into the first quarter numbers. Probably it could come in the second half, and realizations also going up. So needle coke prices, the impact on the margins will be felt in the second half. So is that a concern that you're having? And secondly, it's a commodity business, and stocks have risen too much. Yet you'd still be bullish on this?
See, I wouldn't exactly call it a commodity business, because while electrodes are more like an input to a commodity, so that's a slightly different ball game. Your business doesn't get as cyclical as a commodity, because you're not entirely dependent on commodity prices. At least the market sense at this point of time seems to be that steel domestic demand will do very well for the next probably 10 to 12 years. That's the time it will take for all the infrastructure projects to come up, etc., etc. So I think to that extent, in the next 5 to 10 years, I don't see any risk. You are right. I think with the rising prices, probably margins could get compressed. I am told it's about 3 to 4% is going to be the impact on the margins, which I think is something we can take at this point of time. So I wouldn't really worry too much about that.
Okay, so that's the view that's coming in on the small cap space. Graphite India, no longer a small cap though, but nevertheless, Hari likes it at this point of time. Indian terrain fashion as well as Parag Milk Food are something that our guests have spoken about currently. And the last stock is HUL, currently trading at record highs. It's managed to move up significantly. Valuations much higher than some of its peers, but nevertheless, will the rally continue for HUL is the big question that we're asking. Hari, we'll start with you only. What do you make of HUL? Will the rally continue?
I would believe yes. Okay. I normally try to put Hindustan Lever in perspective. Had you bought Hindustan Lever in 1997 and held it till date, your returns would probably be a little less than what a savings bank account would have given. So if you look at it from that perspective, I don't think Lever looks to be overpriced at this point of time. Having said that, I think if you look at it in pure PE terms, I agree with you that everybody feels a little scared of Hindustan Lever, because I think the stock is up about 75-80% in the last 1 year. So that's, I think, a phenomenal return for a stock of that size. But I would believe that there are certain things like the impact of GST, which is something yet to be just about starting. The what I call the organization of the entire FMCG industry. Number 3, the impact of rural demand is going to come in. Urban spending power is going to increase. I think all that is going to gradually start showing up on HUL in the next 3 or 4 years. So valuations in PE terms may look very steep, but I would believe that even at these valuations, the stock is probably headed up as long as it can maintain its top line and bottom line growth. If you look at the last quarter, I think both top line and bottom line growth is actually much better than expected. So if it can maintain that growth, I would believe at least 2,200 looks to be on the cards.
Okay, I'll come back to you on HUL. Vivek, a minute on HUL. Will the rally continue?
Well, so long as they deliver double-digit top line and bottom line growths, the value, the rally will also continue. Yes, it's been trading not only at all-time high prices, it's also been trading at all-time high valuations when we look at multiples, whatever multiples, EV by EBITDA, or even if you look at by P ratio or cash profits or whatever number, whatever multiple you take, it's been trading at almost 60 times earnings for current year, and even for next year, it's probably about 53, 54 times FY20. Now, just to put things in perspective, what we have seen in the last 2-3 years is the relatively better quality growth stocks, growth plus quality, and quality as defined by high return on capital, high return on equity, free cash flows, and so on and so forth, has seen a disproportionate amount of money moving towards those stocks, and which is why they are at all-time highs. FMCG is one of those sectors, but besides FMCG also there are a whole lot of other companies which are that way.
Okay,
and so long as the growth,
I'll come back to you. Senthil, you have a minute on HUL. You're always negative, but yeah, again, you can.
So it's a great company, first to say, because 50% of the revenue comes from rural, and their distribution, like, it's no match from other players. But if you look at the volume growth in the last 3 quarters, has been in double digit, majorly because of the low base of the last year. So going forward, we don't expect the volume growth to be in double digit, but it can be in the range of 7 to 8%.
Okay.
And second thing is, it's a good business, but as we say, all good business doesn't turn out to be all great investments. So considering the current valuations, which is trading at around nearly 55 to 60 times 1 year forward earnings, it looks pretty much expensive considering the kind of product segments they are into. Like the home and personal care segments are pretty much penetrated in the urban and in the rural also. And if you look at likes of Nestle or Britannia, their product penetration is very much limited compared to the products of the HUL.
Okay.
So we remain quite bullish on the Nestle or HUL, Nestle or Britannia for their packaged food segment categories.
Okay, so that's the view that's coming in on HUL. 2 of our guests are positive, 1 of our guests are negative. We're just running out of time. Vivek, I'll let you complete your sentence. I had interrupted you. Very quickly, we have to wrap up the show.
Yeah, so basically, I mean, so HUL with more than 60% return on capital and return on equity historically. So which is why it's been trading at high multiples, and it's not just HUL. Even Nestle trades at similar valuations, even Britannia trades at similar valuations, and all of them have been delivering double-digit growth. Of course, Nestle growth rate has been higher on back of lower base effect 2 years ago because of the Maggi issue, but that's besides the point. So long as HUL delivers that double-digit growth, I'll take the thread from Senthil. Even a 7-8% volume growth with better product mix and some price increases in an inflationary scenario will still deliver them 12 to 15% top line growth and probably 15 to 18% earnings growth. If you look at last 25 years in inflationary environment, FMCG stocks with pricing power and strong franchises have always done better because they've been able to more than increase prices than, compared to the input price inflation. So net, so long as the growth continues, I think the rally will also continue and the high valuations will sustain.
Okay, so that's the view. Growth is something that 2 of our guests believe will continue for HUL going ahead. So 2 bullish calls and 1 negative call coming in on HUL. But with that, it's a wrap on today's Hot Money. Hari, thank you so much for coming in. Vivek and Senthil, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.